On Business Incorporated today. Angola currency gains 20% in 1 year on oil price boom. Morocco halts exports of tomatoes to Europe. South Africa aviation regulator warns airlines against price hike. Hello and welcome to this episode of Business Incorporated on Channels Television. I'm Ini John McQuarrie. Well, let's get started as usual with market numbers. Kicking off in Africa, mostly positive today. In Nigeria, the NGX benchmark traded in the green. That's the first time trading in the green for the week. It's at a mild 0.04%. In South Africa, the JSE also gained. It gained the most, more than 3%. It was followed by EGX 30. That was almost 3%. And Kenya also closed positive yesterday, 0.17%. The positive sentiment spilled into the Middle East market. In United Arab Emirates, Dubai gained the most, more than 2%, while Abu Dhabi jumped 1.16%. Elsewhere in the region, Qatar index added 0.32%, while Saudi Arabia pulled back 1.5%. Let's go to Europe now. U.S. chip maker Intel Corporation has announced it's expanding across Europe to the tune of $88 billion. It's a move that over the long term could bolster Europe's supply of the much-needed semiconductors. But we have Steven joining us now from Berlin to give us the details of that and a whole lot more. Hello, Steven. Thank you so much for joining us. Well, how important is this deal for Europe?
Well, we've been talking a lot about commodities and shortages in recent days. Semiconductors over the past 2 years have been something like a commodity that's been facing shortage. The pandemic has really put a crimp on the number of semiconductors out there as demand has risen, and that's especially hit automakers very hard. We've seen car makers like Volkswagen in recent months even scaling back their production and closing assembly lines. That's a big deal both for those companies and for workers here, and that's why the European Union has tuned into this. They've been trying to double their market share, the European market share of the chip-making industry. That's an announced goal that they've been pursuing since this spring. This Intel deal, that's $88 billion that's spread out over a decade, and that would both build new sites and it would modernize some older sites in countries like France, Germany, Ireland, and Italy. Now, of course, this is an American company, which sort of points back to one of the weaknesses facing Europe, is that it has been incredibly dependent on Asia and the U.S. for its chips. And granted, it welcomes this expansion across Europe. It's aimed at the European market, but it has to be pointed out that no European company is quite ready to make modern chips like an Intel or like its competitors in Asia.
And speaking of the auto industry, are we getting a clearer picture of how the war is hitting Europe's biggest brands?
We are getting a better idea. Companies are beginning to message that these sanctions, these shortages that we're seeing in commodities, all these issues are going to face automakers not for the short term. They realize that this is a long-term situation. What they're not very clear on is exactly where those shortages are going to be. Things are changing by the moment. We've seen that with commodities like nickel, for example, like steel. We've seen that they've gone up very fast. They've fallen again. We've seen the same thing with oil. And so what we've heard is a bit more messaging. BMW, for example, yesterday, releasing its new figures, saying that it's actually lowering its profit margin expectations for the year to 7 to 9%. Because of the war, they said without the war, it could be as high as between 8 to 10%. And so they're scaling that back a little bit. But again, they weren't able to say exactly where the shortages would be. Volkswagen also saying in its new numbers that it expected supply shortages, perhaps some interruptions as well. But again, it couldn't be more specific in what areas. And then yesterday, we heard some comments at an automotive industry event here in Germany, the head of the German Automobile Association saying, look, this is going to continue for a while. This is going to be shortages. It's going to be interruptions potentially, but we can't exactly say where they're going to be, when they're going to be, what they're going to be. So the general message seems to be this is going to be with us for a while, but we can't exactly say from one day to the next what the issues are going to be.
Yeah, well, we hope this is not another COVID that we have to live with. But looking at the markets now, China and the Federal Reserve are big for investors today. What can we expect for the European indexes?
Right, those are the two issues really that that markets are going to look at today. Of course, the war and how things are progressing there with negotiations, or I should say with talks between the two sides. That's also going to be in view, and that could really send a surge through the market in either direction. But really, China is big on the agenda. Markets have been hit hard recently over some concerns about the spread of COVID-19 infections there and the lockdown of Shenzhen. That's one of the biggest manufacturing hubs in China. There's also been some curtails of the tech industry that have really been biting down recently in China, and then some general economic indicators that have not been very positive. So that's really sent a shiver through through markets in recent days. We've seen the price of oil responding to that. However, we did see earlier today in Asian markets that there was a bit of an uptick, at least in Hong Kong. Investors reacting very positively to comments from a Chinese official that Beijing is going to do more to support the economy. And so that's news that is likely to ripple into European markets as well. And so we're expecting a bit more positive action from the major European indexes today.
All right. Thank you so much, Stephen. Enjoy the rest of your day. From Europe, we go to the UK, where the Prime Minister has begun a visit to the United Arab Emirates and Saudi Arabia, where he will try to persuade the UK's Gulf allies to step up oil production and ease pressure on energy prices. And of course, that's following the war which is ongoing in Ukraine. We have Juliana now joining us from our London studios. Juliana, good afternoon. What are you hearing about this trip of the Prime Minister?
Yeah, good afternoon, Annie. Well, the Prime Minister Boris Johnson has kicked off his regional tour of the Gulf, where he's joined by the UK's Investment Minister, Lord Grimstone. And he's doing exactly what you just outlined. He is trying to persuade the Gulf to start pumping more oil because he believes, the West needs to be weaned off of its dependence upon Russia. And this was all displayed in his pretty scathing article that he wrote in the Daily Telegraph yesterday. We know that he will be meeting the Crown Princes of the UAE at some point today before he jets off to Riyadh for his meeting with the Crown Prince Mohammed bin Salman. Now, this is a pretty controversial point here in the UK. Currently, there are Prime Minister's questions ongoing in the Palace of Westminster. Of course, the Prime Minister isn't there, so Dominic Raab, the Justice Minister and Deputy Prime Minister, is taking those questions. But there are concerns about Britain's ongoing relationship with Saudi Arabia, most notably because on Saturday there were 81 executions in just one day of men relating to charges linked to terrorism. But of course, the most pressing global issue in relation to Saudi Arabia is the death of the journalist, the brutal murder of the journalist Jamal Khashoggi in 2018. His body is yet to be recovered, and according to US intelligence, it was the Crown Prince who actually made that call for his murder. Last week, again, we're hearing that the Crown Prince refused to take a call from President Joe Biden. So although Boris Johnson is trying to coordinate international efforts, I'm not certain that the international community are convinced that Saudi Arabia is the right ally to turn to as it tries to squeeze Russia out of the global economy.
Well, we just wonder how much compromise will have to be taken in order to deal with the issue of buffing up the supply of oil there. But in the commodities market, nickel again has been halted. The trading has been halted. This time, they said the issue is technical.
Yeah, it's been a couple of chaotic weeks at the London Metal Exchange for the trading of nickel. At one point, I believe a ton of nickel was trading at over $100,000 a ton. This is a 250% surge, and it's all linked to one individual and one finance firm, which is Jiang Guanda. He's a commodities tycoon or a metal tycoon based in in China. Now, his firm, the Tsingshan Holding Group, apparently got into some trouble when it came to paying off its debt, and the market responded, which is why we saw such huge surges in the price. Because of this, for only the second time in its 145-year trading history, metal trading nickel trading was suspended. We know that nickel is a key component in the use of electric battery vehicles. We know that's, of course, where the world is heading, as well as, of course, making money, which are not a lot of people using, but of course it's still pretty crucial. So they implemented the London Metal Exchange Group as a new system to ensure that nickel doesn't go above a certain price, and that failed. That failed this morning, so trading had to be suspended again. I do believe right now it is up and running, but because they've put in this new system, it has teething problems, as we know technology does have from time to time.
Sure. Well, how's the market at this time?
Not bad. The FTSE leading all shares, trading in positive territory. Lots of hope, if we could say hope, that some sort of truce could be had between Volodymyr Zelensky and Vladimir Putin. According to the latest statements, negotiations are moving on progressively, so we just have to wait and see. And then, of course, there is that two-day Federal Reserve meeting, which investors are keeping a very close eye on. So at intraday, the FTSE all share is up by 1.37%. The FTSE 100 is up by 1.16%, and the FTSE 250 is up by 2.33%. In the currencies market, the British pound is currently trading up on the US dollar, if I could see that, by 0.26%. It's currently trading down on the US dollar by 0.10%. And at intraday, the British pound is trading up on the Japanese yen by 0.22%, Innie.
All right, Juliana, thank you so much for that update.
Thank you.
Let's move to the U.S. now. Stock futures were higher in early trading after the major indexes rallied and oil prices tumbled below $100 a barrel. Of course, that was all ahead of the Federal Reserve meeting today. Futures on the industrial Dow Jones also climbed, while S&P futures and NASDAQ 100 were also up, both more than 1%, NASDAQ almost 2%. Well, we have our correspondent in Washington, Maria Bird, now to give us details of how trading was yesterday.
The U.S. stock market rallied for the positive on Tuesday, as the Dow Jones closed at 1.8% up. The S&P 500 closed at 2.1% ahead, and the NASDAQ closed at 2.9% up. It is clear that investors are not concerned about potential inflation and that the decline in oil prices has had a positive impact on the U.S. stock market. It is also not as much of a major concern whether or not the Federal Reserve Bank's meeting on Wednesday will create a major increase in interest rates, as U.S. interest rates have not increased since 2018.
Let's see what's going on in the global oil space. Now, oil prices rose in early trading today, bouncing back after early falling more than $1 a barrel as Russia's invasion of Ukraine continues to dominate volatile trading, with ceasefire talks at the latest market trigger. Brent crude futures were up 83 cents to $100.74 a barrel, while U.S. West Texas Intermediate crude rose 58 cents to $97.02 a barrel. Both contracts had earlier declined more than $1, with Brent falling to $98.86 a barrel, with WTI easing to $94.90 a barrel. And closely related to that, in Angola, the oil boom has added fuel to a rally for Angola's kwanza that's made it the world's best performing currency against the dollar. The currency of Africa's second biggest crude producer has strengthened by 20% this year, buoyed by surging oil prices, several credit rating upgrades, and the likelihood that the central bank will continue to raise interest rates. Well, needless to say, the worst performing at this time is the Russian ruble. It's been down 37% this year amid the sanctions against Russia after its invasion. Angola's economy depends on oil for 90% of its exports, and is forecast to expand by 2.9% this year after exiting 5 years of recession in 2021. We'll take a break now here on Business Incorporated, and when we come back, we'll look at what's going on in the African continent. To stay with us, or more from the African continent, I should say. Welcome back. You're still watching Business Incorporated here on Channels Television. Well, the world, including OPEC, has now come to agree that there has to be that there's a need to embrace alternative source of energy along with the use of fossil fuel. The volatility in the price of oil following the war going on in Ukraine has emphasized the exploration or the need to explore renewable energy, which Europe has been doing and is talking about expanding. Well, also in West Africa, there are some projects going on. We have Ted George. Ted George is the Chief Narrative Officer at Cleo's Advisory in the UK to tell us what's going on with renewable energy in West Africa. Hello, Ted. Good afternoon.
Hi, good to be back.
Good to have you back. So which renewables offer the most potential for Africa when we look at the potentials that Africa has?
Well, I think always top of the agenda has been hydroelectric. And you can imagine there's a lot of hydropower stations in West Africa. You think of in Nigeria. You also think on the Congo River. But one of the big issues there is if you don't have industry right next to it using it, you need to transmit that power. And that can be very difficult if it's thousands of miles. And also, you've got to think about some of the impacts socially. If you think about the GERD, the Grand Ethiopia Renaissance Dam, that's causing huge tensions between Ethiopia, South Sudan, and Egypt, which depend on the flows that come from the Nile. So it's complicated. But for me, the obvious one is solar. Not only is there a huge amount of solar resources all across Africa, but it's not just about the big scale thing. It's about distributed power. People having solar units in their houses, let's say in remote or rural areas, and that means they can power their phones, they can power the internet, they can power lighting, their refrigerators, etc. There's a huge opportunity here with solar, and I think that's the really key one which is being pushed out across Africa.
So it seems the conversation around renewable energy has been expanded at this time. Maybe the war in Ukraine and the need for power and the impacts of Russia's supply, being cut off from the global space has also boosted that conversation. Do you think that one of the lessons from the war would be people embracing renewable energy more?
Absolutely. And I think this is the thing. When we see the oil price shoot up to $100 or higher, as it's been in recent weeks, it suddenly changes the economics. 10 years ago, solar and wind were much more expensive than oil and gas. Just before COVID, they were almost exactly the same price in terms of the amount of cost to generate per kilowatt. But the fact is, if you bear in mind how much gas and oil prices have gone up, it's cheaper solar power now as well. So there is on one side, there's a clear economic incentive, but the other one is strategic, as you said. No one can steal your solar. Nobody can cut off the wind to you, but they can cut off gas. And that is what Europe is terrified about at the moment. So I think this whole idea of resource independence is actually pushing renewables much higher up the agenda.
And then following the COP26, have we seen an end of coal? I mean, this has been a long-standing conversation. And then it's when there's a disruption in gas, then countries turn to coal. And what does it mean for Africa, especially countries that export coal?
Yeah, well, I think time is definitely up for coal, but it's not immediate. So much of power and industry is produced from coal, but coal is by far the dirtiest. To get it out of the ground is the worst, and the amount of emissions it does, not just of carbon dioxide, but carbon monoxide and other pollutants is terrible. So it is not a good source of fuel, but we're going to depend on it for a long time to come. So there's a transition underway here, and I think the thing is that the traditional ways that coal is used and burned cannot continue. But in the future, there's all these other new technologies out there. It's a resource that could be used in another way. So I think certainly for the big exporters, if you particularly look in Southern Africa, so many of the coal fields there, the long-term business model is going to have to change because we can't keep on burning coal the way we were before. But,
one of the issues that also come out is the cost, of ignoring or embracing the green energy, the alternative energy, the cost for the economy, if we have to do away with coal, for instance, the cost of developing the solar or the hydro, you know, is Africa ready for that cost?
Well, absolutely, because I think so much of it, if you look at it, partly it's got to be led by governments who basically want the projects to go ahead. But so many of the big solar and the wind projects around the world, which make up the majority of them, are actually primarily funded by private investors. It might be asset managers, it might be private equity, even venture capital as well. The expertise is out there, the technology is out there. And remember, there's a lot of wind in the world, there's a lot of sun. It's just that it's about where is the technology best used for a particular area. So the thing is, I certainly think on the solar front, we're going to see a lot more development. And I think also, particularly in these areas of things like biomass and bioenergy, although there are some green concerns around them.
Well, just before we let you go, how green are these renewables actually?
Well, I think the bottom line is, look, some of them are very green. If you've already factored in the cost for example, producing wind turbines or let's say producing PV solar cells, the actual power they produce is almost totally green. But if you take something like biomass, burning charcoal, if you're talking about making biofuels, that's when there's a real question about the CO2 coming out. So I think the real thing is read the small print and check the kind of green credentials you have, because not all of them are green.
Yeah, read the small print. Thank you so much, Ted George, Chief Narrative Officer at Chaos Advisory in the United Kingdom. Thank you so much for sharing your thoughts with us.
Cool. See you next time.
So moving on now, Morocco will cut back exports of its mainly Europe-bound tomatoes, seeking to tame a pre-Ramadan surge in local prices for key components of the kingdom's cuisine. The move adds to a raft of crop protectionism worldwide as the war in Ukraine is accelerating food inflation that's already heading up, spurring governments to ensure domestic supplies by restricting trade abroad. Morocco sends about 430,000 tons of tomatoes to the European Union each year, making it the bloc's largest outside supplier. Drought in the North African country has caused the price of one of Morocco's cheapest fresh staple foods to surge over the past week, and inflation has stoked rare protests. In South Africa, the Competition Commission has cautioned airlines against price gouging after the South African Civil Aviation Authority announced the permanent grounding of Comair and its subsidiaries Kukula.com and British Airways. The Commission says that it understands that the removal of airlines does certainly have an impact on airfares. The situation that stranded passengers find themselves in should not be unduly exploited by other airlines. The Commission has encouraged all airlines to put more capacity into the market where possible until Comair situation has been resolved in order to assist stranded passengers at more moderate prices. That's it for the program today. Thank you so much for being a part of it. We have 2 more to go for this week. I'm Ini John Mekwa. Enjoy the rest of your day.